So today I want to talk a bit about what happened last Friday. The market turmoil deepens with jobs. A look ahead, what is expected next of it. Now, the economic landscape is becoming increasingly turbulent on Wall Street, fueled by mounting concerns that persistently high interest rates might be starting to throttle the US economy. Now, I've spoken about this in the past already. I've said again and again, the number one, the first point is that bad news, there will be eventually one bad news that's going to push the market down regardless, even though you're seeing price is going up and going up and going up. Eventually something will happen because an economy can't grow with high interest rate. Number two, I've also said that the market was actually operating in a very illogical environment where they were hoping for more bad news, and with every single bad news that we have in the market coming out, then the traders were actually pushing the S&P higher and higher and higher, thinking that eventually the Federal Reserve would cave in and actually cut the rates, right? So if you think about it, there's no logic there. Bad news, market go higher. So I've also said eventually you will see bad news equals to bad news, and then everybody start realizing it's not good. So that is what is happening at the current moment. So the latest data from the Labor Department reveals a significant underperformance in job creation, with only 114,000 non-farm jobs added last month compared to the previous month of 215,000. Excuse me. Now, experts suggest that at least 200,000 new jobs are required monthly to keep pace with population growth, pointing to a notable slowdown. Now, this 200,000 point has been a number that I've said in the past already. Below 200, as long as jobs is above 200,000, even though it has dropped from a higher level, it's still considered a very good number. Okay, so now it's below that. So we also have July's unemployment rate surged to a nearly 3-year peak of 4.3%. And this reflects a worrying trend in the labor market, stirring fears of an impending recession. This incremental rise to 4.3% from June's 4.1 marks the fourth consecutive month's increase, setting the stage for a potential rate cut by the Federal Reserve. Now, this all but guarantees a September interest rate cut from the Federal Reserve. The data prompted traders to pile into bets that Fed will deliver a half percentage point rate cut at its September 17 to 18 meeting. Now, previously, we were only looking into 25 basis points. Now, with such bad data, they're thinking, I said, why not look into the 50 basis point rate cut? Now, there were also calls to look into it seriously, into the number of cuts as well. Okay, now now that a September rate cut has come into view following a Fed meeting last week, it intensifies investors' concern that high borrowing costs may have already begun to stifle economic growth. Adding to unease are last year corporate earnings report from major firms like Alphabet, Amazon, and Intel, which have further heightened apprehensions about the economy outlook. Now, with regards to lecture corporate earnings from Alphabet, Amazon, Intel, let me be very clear. Alphabet, Amazon, their earnings is still I would still consider okay, but it's not what the market is expecting. But overall, it's still profit from them. Okay, and I don't think it's a problem. So, but when investors are looking for certain things, they kind of heighten something that is they don't expect, and then they heighten it and make it worse. That's all. That's what I think. Now, further compounding the grim outlook, the report noted that the growth in annual wages last month was the weakest in over 3 years, prompting Bank of America Securities and Goldman Sachs to adjust their forecast. now expecting a rate cut as early as September, potentially up to 3 cuts within the year. Before this, they were only expecting 1. That's what the projection given by Fed. They have changed that 1. Now they're looking into, Bank of America saying there's 3. Now this shows the sudden change, and changes like this also shows the overall health of the economy as well. Stock market in general. So this is something that we need to look into detail closely. Now, interestingly, the rise in unemployment rate triggered the Sahm Rule, an indicator suggesting a recession when the 3 months moving average of the unemployment rate climbs 0.5% above its low from the previous year. So it has triggered. This is an indicator, that is showing this possible a recession may be happening. Yet some economists remain optimistic, attributing the rise in unemployment to an influx of immigration-induced labor, okay, rather than an increase in layoffs. Layoffs is not good. Layoffs means that the economy is not doing well. Companies are not doing well, so they are doing layoffs. But if this unemployment is due to the employers prefer immigrants to hire immigrants than the local US people, then that's a different thing. It still shows that overall the company still can sustain. Okay, at the end of the day, the stock market is based on profits. As long that the companies are still reporting profits, the stock market will continue to go up higher and higher and higher. Now, you need to know one thing: the stock market is not the economy. The stock market is an indicator. The stock market is different, totally different from the economy. Okay, now a lot of people think that, oh, the stock market is down, economy is not good, that kind of thing. It doesn't. There are many times when you have the NBER, right, saying that, oh, now the US economy is officially in recession. And when that happens, when they have announced that, you probably would have seen already the US stock market would have already bottomed long time ago and maybe moved up 4 months, already been up on the uptrend for 4 months. Then only they announce, right? So at the end of the day, there is no evidence of a recession, even though you have 2 indicators, the SAM saying that possibly may happen. You have the negative yield curve also showing that it may happen. Right now, at this current moment, the data are still not suggesting it. Yes, the market is weak. We don't deny that. But as long as demand, that's where don't drop away from supply, then it's still okay. Okay, so that's what we're seeing with the current data. Nevertheless, the concern remains that the Federal Reserve may have delayed rate cuts too long, potentially necessitating more aggressive reductions to support the economy. As of June, Fed policy makers had projected only 1 rate cut for the year, aiming for a 4% unemployment rate by year's end, and a target now that's already surpassed. We're in there. So they're now thinking, are there any possibilities these may change? This thing may change. So the performance of S&P 500 companies have been mixed relative to expectations. While there is an above average number of companies reporting positive earnings surprises, the overall significance of these surprises have been relatively subdued. Okay. Now, looking ahead, the third quarter of 2024 will be crucial for assessing the US economy's health, as 39 S&P 500 companies have issued negative EPS guidance against 35 issuing positive guidance. So we still need to see the overall developments of this, what do you call, the companies. So end of the day, then we will have a clearer idea what's next for this. Okay, so with this, that's the end of the report for today. fundamental report. Let's move on to the charts.